Hey everybody, Boris Lasser, BK Forex. Welcome to our Forex Weekly Technicals for 5/12/5/16/2014. Where are the trades? Well, what an unbelievable difference a week makes. Last week we were sitting here crying big tears that there was no volatility, that Euro basically is moving nowhere. And look, within 2 days we've tacked on, I think, close to 200 points, which is a massive move, given the fact that I don't think we moved 100 points in a month. As the Euro did a complete reversal. So Draghi's jawboning, Draghi's threat of a potential action in June certainly did the trick for the Euro and created effectively a double top here at the 140 level. Clearly the ECB is concerned about this level. Clearly this is a Maginot line for policymakers. And technically now we have a very hard level against which we're going to trade as far as the top goes. Having said this though, the Euro does have technically support here at 37. It's been slicing viciously through all of these levels quite effectively over the last 2 days. But generally, when you have such sharp moves, it's unlikely that it's going to put in 3 or 4 consecutive days of liquidation. Although the market has been very long, so it's not impossible to think this way. But I do think there's a potential here for at least a small stall and a bounce at 37, and then a bigger support level here right underneath the 36.50. Ultimately, if you look at this on a longer term basis, the Euro could unwind all the way out to 135, especially if they go through with the threat of having lower interest rates. The key primary reason why the Euro now is completely turned is if you get into a situation where it actually costs you money to hold euros. That is, if you go to negative interest rates, anybody who's a Euro depositor is going to see his money disappear, even on a tenth of a penny per day. There will be a massive outflow from euro-denominated accounts into dollar-denominated accounts, if for nothing else than just to simply keep your money flat. And that creates, I think, a completely different dynamic into the marketplace that's just breaking the back of this Euro euphoria that we've had over the last few months. So really worthwhile watching. Technically, certainly massive breaks here. Every rally is a sell at this point, as far as traces back up to 38, 38.50, 39. If you're a longer-term trader, of course, the 140 remains the key sell point against which you hold your positions. On a short-term basis, we have had big sell-offs, so some kind of a bounce is probably due, maybe around 37. It's certainly not a time to chase the short side, but it is definitely a time to consider selling on a retrace or any kind of a bounce if the Euro sees one as we go forward. Dollar-yen story is much different here. It's just basically a continuation of low volatility, low compression environment. But what we do see continuously here is this modest dollar strengthening. U.S. yields basically look like they've stabilized. I mean, basically at this point, unless U.S. yields go to 2.5 on a 10-year, it's very unlikely that you're going to see the dollar-yen break this 101.50 support level. There is some incredibly interesting dollar bears who are arguing, or yen bulls that are arguing for like 85 yen return. I find that hard to believe. I think yen structurally is just not nearly as attractive a trade as it used to be, and generally, as long as U.S. rates just basically stabilize at these levels, the downward pressure on dollar yen should really cease to be a dominant force. It doesn't mean that we have a big upward move, but it looks like we can just consolidate here for a further while. Pound dollar following Euro into liquidation, and here the liquidation is really, it's not a question of being negative pounds, but it's just simply a Me Too trade that's triggering tons and tons of stops. I still think the Euro pound on a relative basis is just one of the more interesting trades now, given the fact, and indeed the Euro pound on a relative basis continues to be an interesting sell trade here, given the fact that you will have sooner rather than later an expanding interest rate differential between UK and the rest of Europe, assuming that the Bank of England does begin to move towards a more tightening regime. We do have this Wednesday the Bank of England inflation report. We have Carney in front of the press. It should be a very interesting event. It could be one of the most pivotal, volatile events for pound and pound crosses, and we'll see just how aggressive they want to get on the interest rate structure. If he suggests that something is possible, perhaps even before the end of this year, that would be massively pound bullish, and you will see Euro pound here at 81. So overall, the breaks here below 81.50 could suggest a move all the way out to 8100 on a surprisingly hawkish BOE. That's still a very long shot, but it's a possibility and therefore worth watching this week. Aussie dollar, trading relatively well relative to the European currencies. That is, everything is holding bid here quite well. Data out of China was very supportive. We do have a little bit of a Chinese dump coming up next week, and that could be a supportive or dilutive to Australian dollar. We'll see where it trades. For now, this 94 still is a very, very tough double top to overcome, and it looks to be more like a consolidated phase here where we have lower volatility moves. If Chinese data comes in positive, then a pop through this 94 and a challenge towards the 95s could really be very much in the cards. The reason why is because if China really isn't slow, if China isn't really on the verge of teetering into a recession, there's very little reason to think that the RBA will not increase rates as it goes forward, simply because the Australian economy is far healthier than everybody thought it would be. So it could defy a lot of odds, and you could have a pretty strong squeeze here at those 95s if you have positive Chinese data. So definitely worth watching on a relative basis. This, of course, opens up very interesting relative trades too as well. If you get positive Aussie news, then the euro odd trade just becomes a dive through the 45s. I mean, through the 46s basically towards the 45s and ultimately towards the 43s on a cross basis. Dollar CAD got tripped up today pretty badly on very, very ugly employment data. So it looks to be right now that we may be setting in a little bit of a short-term bounce here off the 108.50s. And it's also, by the way, creates, of course, CAD under performance against the Aussie. So Aussie CAD, which was very, very slow, had a little bit of a trace off the 103s, maybe a trade back up to 103s. If you get positive Chinese data, if you get positive Australian moves, because dollar CAD is certainly going to be anchored down by the idea that there isn't just enough growth in the Canadian economy to convince the market that the BOC is going to move to a truly neutral to hawkish posture. As my friend Adam Bottom said today, that it's been such a bad day for Canada they even lost to France in hockey. So not a great day for Canada. Potential underperformance here for Canadian going forward. Let's take a look at the Kiwi last. Where's my Kiwi here? Oh, sorry. I'm losing my mind here. No, I'm sorry. It's Kiwi dollar. That's why I'm looking for dollar Kiwi, because I was just talking about dollar CAD. Okay, so Kiwi, on the other hand, very, very much underperforming against this. This is under the very strong jawboning from the RBNZ, and bad performance on the dairy prices. Dairy prices have come in significantly over the last 3 or 4 months, and suggest basically that effectively the RBNZ may just do another rate hike and then stop for quite a while. Remember, we have about 50 basis points of rate hikes factored in, perhaps even 75 basis points factored in for the end of the year. And it may be only a matter of where they only hike 25 and just wait and see, because they do not want to see the Kiwi really above the 85s, but they certainly don't want to see it towards the 90s, because that really weighs down. They're very, very exchange rate sensitive. In fact, they threaten to even intervene in the exchange rate market if the Kiwi begins to appreciate. So you have this underperformance on the Kiwi, which we've had for several days. Having said this, though, this still remains the predominant yield trade in the G20 universe, in the advanced nations universe, and therefore it really looks to be, on a purely fundamental basis, a potentially interesting buy anywhere from 86 to 85. So you do have this triple bottom support 85, right? And ultimately, you really would have to have some significant negative fundamental news to want to try and break this support. So if you're a scaled down buyer into this with a hard stop below 85, this might not be an interesting, and that might not be a bad trade for bargain hunters for a look forward. And of course, it's a carry positive trade as well. So I do think that Kiwi may have a little bit more of a correction, but the worst of it is behind it. And we may simply even out and perhaps do a small bounce back up to the 87s based on the fundamentals that we go through. On a relative basis, though, so what does this leave us with Aussie Kiwi, which has been really performing quite well? Well, it leaves us potentially, again, if you sort of believe that the Kiwi does not drop below 85, with a potential triple top over here. So you kind of have a dual trade here. You can short Aussie Kiwi all the way up to the sort of swing highs here of 109.50, or you can try and get scaled down long Kiwi dollar, or you can do both, which is effectively and implicitly bet on the fact that the Kiwi is not going to go down much further beyond these levels. Because its interest rate structure is still just too attractive for yield traders. So that's kind of how the week shapes up. Thank God volatility is back. Thank God there's more trades to consider. I wish you guys the best of luck, the best of trading. I'll see you guys next week. Boris Schlossberg, BK Forex, over now.